This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, I'm going to go through and finish things off by looking at a situation whereby you are making an investment in a project. The project requires you to invest in an asset, so some machinery, but we have to make the decision as to whether or not we're going to lease the machinery or whether we're going to go through and buy the machinery. And the way in which we look at it is by determining which of the two methods is the cheapest. So we're looking at it purely from a financial perspective. Now, there are other issues to consider, but I'm not too concerned about those for now. What we're considering is whether or not it is cheaper to buy the asset or whether it is cheaper to go through there and lease the asset. Okay. Now, looking at it from a financial perspective, we need to look at the cash flows. We need to look at those cash flows into the future and discount them back to present value. So when we're looking at the cash flows, we need to think about what cash flows that there are. So when we're thinking about buying the assets, you're going to have a cash flow initially of the purchase. You'll have a cash inflow of the sale of the asset at the end of the project's life. And then there will also be some tax savings from the tax writing down allowances that we are able to claim. Okay, that the tax depreciation, if you so wish. We also need to look at, from a lease perspective, what are the lease payments as a cash flow, and then what is the tax saving on those lease payments. So once we've got the cash flows, we then need to think about the discounting. And whenever we are doing the discounting, we are also always, I should say, looking and discounting at the after tax cost of borrowing. Okay. So look at the rate of interest that you have on your loans, the borrowing rate, and look at an after-tax rate. Okay, because when we're looking at the cash flows, we're looking at after-tax cash flow. So it matches up the cash flows and the discount rate that we use in our discount factor. We take the cash flows, we do the discounting, we look at the two, and then look at whatever gives us the lower present value. Okay, because that's therefore the cheapest. Okay, just be aware. There won't be in the future when IFRS 16 takes into the world, but at the moment we don't need to worry about that. We have currently IAS 17, and we have the two types of leases being a finance lease and is an operating lease. Okay, so what we've got there is we need to go through there and look at the finance lease. So what you've got there is you look at, is it the annual post-tax lease rentals? So look at the rental, look at the tax saving on the rental, and then if there's any repair cost, discount that back to present value. Okay. You'll be told any additional cost that there may be under the finance lease. In terms of the operating lease, very, very similar. You take the annual post-tax lease rentals and discount them, is it there, to present value. Okay. There's no repair cost because we don't have the risk and reward of ownership. So therefore, we wouldn't have to pay any repairs. For the finance lease, you would need to go through there and make the payments. Okay. The difference that you have effectively between the payments for the buying and the lease, we just compare them in present value terms. As we said, we go with, is it there the cheapest? Okay. I think I've just about covered the essentials. Okay. So let's go through there and shall we have a look? Okay. Simple question: should the machine be leased or purchased? Okay. We will lease it if it is cheaper than purchasing it. So what have we got? Company is considering whether to buy a new machine at a cost of $100,000. So that is what we buy the asset at. Is that there today at T0? Or alternatively, to lease it for $35,000 per annum. In brackets, it's important, the lease payments are payable at the start of each year. So the payments are in advance. So the first payment that we make is at T0. Okay, the issue is how many years does that then go on for? Okay. Buying it will involve borrowing money after tax tax interest cost of 7% per annum. So that's our discount rates. If the machine is bought, it will be bought on the last day of the current financial year. That's important for tax purposes because it will determine when we claim those tax writing down allowances. Okay, because if we get the asset on the last day of the current financial year, then for this financial year, we will claim some tax writing down allowances, but we'll see more of that shortly. The machine will be needed. Is it there for 4 years? So when I'm looking at my lease payments, there are 4 lease payments. Those lease payments are at the start of the year. So that's going to be quite funky because that's T0 to 3, isn't it? 0, 1, 2, 3. Okay, because they're at the start of the year. Okay. We'll have a scrap value after 4 years. Is it there 10,000? So if we buy it, that's going to be arising there. Is it at T4? Okay. Corporation tax is at 30%. Wow, that's really high, isn't it? But there we go in today's economic world. But that's what we're going to go with. And that tax at 30% is payable 1 year after. So this is the year T0. It will be paid in year 1. If it arrives in T1, it'll be paid in T2. If it arrives in T3, it'll be paid in T4. If it's in T4, it'll be paid in T5. That's where we've got to be careful because we have a 4-year lease or buy decision, but because the tax is made after the end of the year, okay, and 1 year after it, it's 5 years that we need to consider. Ooh, that's nasty. I'm not sure whether your objective test question could be that cruel, but you never know. Capital allowances, so your tax depreciation is there, 25%, reducing balance. Okay, excellent. So what do we do? We've got all the information that we need. If we're going to lease the asset, so where there is it T0, if I can squeeze it on 1, 2, 3, 4, 5. Just don't forget that 5th year is the tax. So what we have there is that we have your lease rentals. Is it there 35,000 at T0 and then 35,000 at T1, 2, and is it the T3? Okay, excellent. Then what we've got to go through and do is you then have, is it the tax? This is where you've got to be really careful because the tax is, what's that, 30%? So if I go through there, use my calculator, 35,000 at 30% gives me 10,500. Now, the lease is in the 1st year. So even though the payment is at the start of the year and is in T0, okay, the lease commences in that 1st year, doesn't it, in year 1. So therefore, this is where it's tricky. I think I've made it too tricky, but there we go. The tax saving at 10,000, is it 500, is in year 2. And then as there is a 4-year lease, there will be $4 years worth of those tax savings. Boy, oh boy, oh boy, that's a challenge, isn't it? Okay, we lease the asset in year 1. Okay, so the tax is paid 1 year after, so that will be in year 2. Okay, but in terms of cash flows from the lease payments, because the lease payment is made at the start of the year, that's at T0. Okay, yeah, that will keep you thinking, won't it, for many days to come. That then gives us, is it the net cash flow? So is that the T0, 35,000. At T1, it is also 35,000. Okay. We then have, is it 24,500, another 24,500, and then is it just the tax savings in the last 2 years at 10,500. Okay. You've then got, is it your discount factor? Your discount factor there is at 7%. .935, 0.873, just taking them straight from your tables. 0.816, is it 0.763 and 0.713. To work out, is it then the present value? 35,000. 32,725. 21388. 9992. And then we just need to be careful, don't we, because they are savings cash inflows of 8011 and 7486. Okay. If you then go through, total that up, the total present value is 93608. Okay, so here it's a lease. We're just treating it as a simple operating lease with the cash rentals and the tax savings therein. The finance lease might have different situations with regards to the tax, but you'd have to be specific there to what it mentions in the question. Here we've just got the tax saving on the lease rentals under your operating lease because we don't have any in substance ownership of the asset. Okay, so we've got there at the moment on the lease 93,608. If we buy it, is it cheaper? Well, when I go through there and buy it, again, I'm looking there, T0, 1, 2, 3, 4, 5. Okay. I buy it initially, don't I? Is it there at 100,000 at T0, which is today? And then I sell it at T4. Was it there for 10,000? Okay. What we then need to do there is we then need to look at the tax, and I've done that as a separate working. Okay. I will then go through and look at the discount factor. Once again, is that there at 7%, and then the present value. Okay. Again, let's just put them in now whilst we're there. Discount factor, is it at 7%? Is 1, 0.935, 0.873, 0.816, 0.763, and 0.713. Okay. The tax, I've copied it out already. It's just take ages, wouldn't it? Okay. And this is where you've got to be careful. Okay, because when we go through there and look at it, you buy the asset, don't we, in T0. Okay. And in the question, it said that we bought the asset. Okay. For $100,000. That's bought there, is it at T0, and it is bought on the last day of the current financial year. Okay, so what then happens is when I buy that asset, is it there at T0, it's the day before the start of the first year of use of the asset. So if we started using the asset on the 1st of January, okay, we actually bought it on the 31st of December, okay, so we will actually get capital allowances in that time period, T0, okay, that's when we claim them, but they will not arise, is it there, until T1. Okay, say that again. Okay, we buy the asset today, and today is the last day of the financial year. Okay, so we buy it on the 31st of December. We start using it on the 1st of January. Okay, assuming we have a December year end. If that's the case, it will be used in that first year, but we claim the allowance for our preceding year, and therefore in T1 we then have the tax saving. So that's in T1. That's there based, is it, on my 25%, reducing balance. The tax is there, is it, at 30%. So 25% of 100 is 25. 30% of that is 7,500 at T1. What then happens is when you then use the asset again, is it there in the next year? It's T2, T3, and T4. Okay, but when you use the asset in its fourth and final year, that's when you sell it, isn't it, at T4? So the balancing allowance that arises in T4 isn't then part of the tax computation until T5. Okay, it's so difficult. But what you've got is, because of the date when you bought the asset, you have this additional, if you like, tax saving from T0. You know, if we'd have bought it at the start of the year, it would have been buy it in T1, tax would have been at T2, T3, T4, T5. Okay, here we buy it in T0, so we've got it in T1, 2, 3, 4, and 5. Okay, just be very careful, and that's really nasty. Again, I think I may have gone over the top, but there we go. Nothing wrong with that every now and then. So what we've got there is that the tax in year 1 is 7,500. If we carry on, is it 5,625? In 3, it's 4,219. In 4, it's 3,164, and in 5, it's 6,492. Okay, net them all off. 100,000 T0 is that 7,500 T1. T2 is 5,625. Again, it's a bit repetitive, isn't it? So you may wish to take shortcuts when you're looking there at your exam and not write it out as long-winded or long-handed, I should say. 13,164 and 6,492. Present values, again, tap away on your calculator. 100,000, is it 7012, 4911, 3443, 10044, and is it there 4629. Okay, totaling that up, your total present value, is it there, negative 69961. So that's what it costs us to buy the asset, compared to when we leased it at, is it 93608. So therefore, based upon that, we would buy the asset as it is cheaper. Okay, so should the machine be purchased or leased? It should be purchased. Why should it be purchased? Because it is cheaper in present value terms. That ignores other things in terms of will we actually get the 10,000 at the end of the asset's life? Okay. Will the tax rate remain at 30%? Might it change? Okay, that may impact things. Will the capital allowances still be allowed to be claimed? Might there be different tax treatment depending upon the country that you're in terms of the lease? I think we treated it as a simple operating lease. What happens if maybe it was a finance lease and there was different treatment to adjust for? So it's not just purely down to the numbers. Okay, what might happen if, say, that the machine broke down? If you bought it, you've got to repair it, but if it's leased, you can just take it back to the lessor and get a new machine quite quickly, can't we? Okay, so there's a lot to think about. Okay, but from a purely financial perspective, you need to go with the present value of the cost that is the cheapest. And here, that was the purchase. I think that question just goes a bit too far. It's long-winded, it's complex. Your objective test questions would be much shorter, but still challenging. Okay, I think they might have to go through there and just ask you for parts of it. So make sure there that you know that you use the after-tax borrowing rate from purchasing it. Okay, make sure that you know the tax treatment. Make sure there that you know how to do the discounting. Other than that, have a work through the questions, keep practicing. If you get stuck, you know where I am, but that's it from this chapter, and we'll move on to the world of equity finance within the next. For now, bye bye.